Are you ready for the largest tax cut in American history? Well, President Trump has officially laid out his tax priorities as Congress prepares to pass a bill, and if this passes, it will literally be the largest tax cut ever. I mean, seriously, just watch this clip from his press secretary.
No tax on tips, which is obviously a very public campaign promise that the president made. No tax on seniors' Social Security. No tax on overtime pay. Renewing President Trump's 2017 middle-class tax cuts. Again, these are the president's priorities. Adjusting the SALT cap, eliminate all the special tax breaks for billionaire sports team owners, close the carried interest tax deduction loophole, tax cuts for Made in America products.
And following this announcement, the White House posted the same summary on X. So, as a licensed CPA that has been following every progression in Trump's tax plan, I want to help you understand what exactly is going on here, and more importantly, how you can benefit from these potential tax cuts. All right, so let's start with the top of the list here. Tax priority number 1, no tax on tips. So the current rule right now is that tips, just like any other form of income, are treated as taxable income, and when we report it, we pay income tax, Social Security tax, and Medicare tax on that income when we file our taxes. However, Trump wants tip income to be exempt from taxation altogether, which means that tipped workers would not have to pay any tax on their tips. And this would benefit over 4 million tipped workers in the US that receive this type of income, like bartenders, waitresses, servers, drivers, and other hospitality-related professionals. Now, as a CPA, I believe a silent motivator for this tax cut is the simple fact that millions of dollars of tip income is already going unreported in the US, and the IRS has historically faced challenges with taxing tips in general. And it's because many people receive their tips in cash, which makes it very easy for it to fly under the radar from a tax perspective. Now, the government obviously knows this and has even offered tax credits and incentives to encourage employers to report their employees' tips, but ultimately, Trump wants to cut all of this out and just eliminate tax on tips altogether. So with that said, let's move on to tax priority number 2, no tax on Social Security benefits. So right now, over 65 million people receive Social Security benefits in the United States, which include retirees, disabled workers, and survivors. And the current rule right now is that those benefits are treated as taxable income to those recipients when they earn over $25,000 as a single taxpayer or over $32,000 when filing jointly with a spouse. And when that happens, anywhere from 50 to 85% of those benefits would be taxable to those individuals who receive those benefits, depending on how much income they actually earn. But now Trump wants to eliminate the tax on Social Security benefits altogether, which would save millions of taxpayers more money in taxes. Tax priority number 3, no tax on overtime pay. So right now, over 10 million taxpayers work more than 40 hours per week through their jobs. And right now, when you work overtime hours, that income is included with all of your other taxable income on your tax return. So working more overtime hours just means more wages that are subject to taxes, or in other words, more taxes. But now President Trump wants to eliminate taxes on overtime pay altogether as a way to incentivize hardworking individuals that log overtime hours, as well as helping the businesses that they work for, since those businesses also need people to work.
That gives people more of an incentive to work. It gives the companies it's a lot easier to get the people.
Okay, so if Congress passes this policy, millions of overtime workers would be able to keep more of their hard-earned money and pay less taxes. Tax priority number 4, renewing the 2017 tax cuts. Now, this is very important because while everyone is looking for new tax cuts, little do they know that the current tax cuts that are in place right now are temporary and will actually expire at the end of 2025. So let's walk through this, starting with the tax bracket cuts. So in 2017, Trump cut several tax brackets. For instance, he decreased the 15% tax bracket to 12%, the 25% tax bracket to 22%, and the maximum individual tax bracket from 39.6% to just 37%. Well, if Congress does not pass anything this year, these tax bracket cuts will expire and tax rates will go right back up, And this is just one example of one of the many expirations. The next big tax cut that is set to expire is the standard deduction increase. In 2017, the standard deduction more than doubled, which resulted in less taxes for millions of people regardless of their income. For example, in 2025, the standard deduction is currently $15,000 for single taxpayers and $30,000 for married taxpayers filing jointly. And if this expires, then the standard deduction could be cut in half, which would increase taxes for most people. And then there's also the 20% QBI tax deduction, which has granted qualifying business owners and independent contractors an immediate 20% deduction against their business income. So for example, someone with $100,000 in business income would be able to take a $20,000 write-off against that income, leaving them with just $80,000 remaining to pay tax on. And that too is set to expire at the end of 2025. Plus, there are also several other tax provisions that will be of interest to many business owners and investors, such as bonus depreciation, for example. Bonus depreciation has allowed investors to write off up to 100% of certain investment property that they buy, like real estate, equipment, machinery, vehicles, and so much more. And this provision actually started phasing out in 2023 and is set to expire completely by the end of 2026. And many people, including my clients, are hoping that this provision is also renewed. Now, altogether, the provisions here have resulted in significant reduction in taxes for many people who are still benefiting from them to this very day. And President Trump has made it his priority to extend these types of tax cuts. Tax priority number 5, adjusting the SALT cap. So if you don't know, SALT stands for state and local taxes. And this has been a major topic of debate, even amongst Republicans as they prepare to pass this tax bill. So let's break this all the way down here. Okay, so before the 2017 tax cuts, state and local tax deductions were not capped at all. And this allowed taxpayers to deduct an indefinite amount of their state and local taxes, like property tax, sales tax, and even local income taxes. Well, when the 2017 tax cuts passed, it capped this deduction to just $10,000, which actually upset a lot of taxpayers, especially ones in high tax states like New York, New Jersey, California, and so on, because now this actually resulted in many people losing tax deductions that they were used to claiming in prior years. For example, let's just assume you paid $30,000 in state and local taxes, which you normally write off on your tax return. And then all of a sudden, Uncle Sam says, hey, you can only write off $10,000 of those same taxes, resulting in a loss of a $20,000 tax deduction that you would have otherwise been able to take. Well, if that's you, then you would probably be upset, right? Plus, on top of this, many people actually chose not to write off any of their SALT taxes because it just didn't make any sense with the increased standard deduction being much higher than all of their itemized expenses that they had. Which means that in the same example, some people actually felt like they lost a $30,000 deduction or their entire SALT deduction as a result. Now, fortunately, President Trump wants to adjust this SALT cap, but it is unclear what it will exactly be adjusted to, especially with it being such a highly debated topic in Congress. Some proposals suggest doubling the cap to $20,000, while others want the cap to be eliminated outright. Tax priority number 6, tax cuts for Made in America products. Okay, so in 2017, Trump cut the maximum corporate tax rate from 37% down to just 21%, which was a permanent tax cut that does not expire. But now Trump wants to decrease the corporate income tax rate again, except this time he wants to decrease it for corporations that make products in America. And for qualifying corporations that do, their tax rates could be as low as just 15%. And other corporations may still see a 1% decrease in their tax rate, bringing it down to just 20%. Now, this is very consistent with Trump's overall economic plan to increase domestic production in the US while somewhat discouraging imports from other countries through the use of tariffs. Tax priority number 7, closing the carried interest loophole, which directly affects private equity firms, hedge funds, venture capital firms, and many investors that park their money into these funds. Okay, so basically, when these types of funds earn profits, they are able to have those profits taxed at lower long-term capital gains rates, which are much lower than the ordinary income tax rates. For example, the maximum long-term capital gains rate is 20% right now, while the maximum ordinary income tax rate is 37% for individuals. But Trump actually intends to close this tax loophole by taxing carried interest as ordinary income, as opposed to them benefiting from the lower capital gains tax rate. Tax priority number 8, eliminate tax breaks for billionaire sports teams. So apparently billionaires that buy sports teams have been arguably abusing the tax law by taking massive tax write-offs against their purchase. Just take a look at this chart from ProPublica. It shows Steve Ballmer, the owner of the Clippers, with just an 11.6% effective tax rate despite being a billionaire. While some of the most successful athletes, like LeBron James, for example, have an effective tax rate of 35% upwards to 40%. So how exactly is this possible, and how are sports teams maneuvering this loophole? Well, usually when you buy any business, you can write off a portion of the tangible assets that you buy in that business. Tangible is very important. So when you buy real estate, equipment, machinery, and other assets that have a physical form, or in other words, can be touched or felt, you can write off that from your taxes. So this is pretty standard, right? Buyers are able to depreciate this type of property as a write-off on their tax return. So what exactly is the problem then? Well, usually these types of write-offs exclude intangible assets, or in other words, it does not include assets that cannot be touched or felt, like customer lists, contracts, goodwill, and so on. That is, unless you own a sports team. Apparently, there are very specific tax provisions that allow sport team owners to write off significant portions of their intangible assets, like media deals, player contracts, goodwill, and so on, while most other business owners cannot actually do this. And by the way, those assets can be worth hundreds of millions, even billions of dollars, which means that those write-offs will be just as beneficial for those owners on their tax return. Well, now President Trump wants to close this tax break up, and it is currently unclear how exactly that will be done. But I would assume that these types of deductions would be limited in the future for sport team owners. So those are the Trump tax priorities. But what should you actually expect to happen next? Well, for starters, with Republican control over the House, the Senate, and the presidency, I think it is highly likely that Trump will pass a significant tax cut this year that will reduce taxes for millions of taxpayers. But what we don't know is when exactly this will pass, what exactly will pass, and to add to that, there's going to be a lot of back and forth between Congress as they try to iron out the details, the budget, and find a way to get this done. So if you want to stay in the loop on this, just make sure you subscribe to our channel to stay updated here. And if you currently pay a lot of money in taxes and want immediate help in reducing it, just apply to work with one of my CPAs today at mycpacoach.com.